The big headline today was the launch of the World Economic Outlook at the International Monetary Fund here in Washington, D.C., and the Global Financial Stability Report as the International Monetary Fund warns of risks but resilience among countries across the globe in the face of trade tensions and fragmentation.
With growth projected at 3.2% this year and 3.1% next year, while inflation has increased modestly and is proving more persistent. Now, what explains this modest impact? First and foremost, the tariff shock itself is smaller than initially feared, with many trade deals and exemptions. Most countries also refrain from retaliation, keeping the trading system open. Financial conditions remain loose, in part because of a weaker dollar. In some countries, such as Germany and China, fiscal policy turned expansionary. And in the US, an AI and tech-driven investment is booming. Despite all these offsets, the tariff shock is here, and it is further dimming already weak growth prospects. The outlook remains fragile and very sensitive to news on the trade front. Flaring up trade tensions with the potential for supply chain disruptions could quickly lower global output by as much as 0.3 percentage point, as we explore in our downside scenario. There are echoes in the current tech investment surge of the dot-com boom of the late 1990s. We're seeing surging valuations, booming investment, and strong consumption on the back of solid capital gains. The risk is that with stronger investment and consumption, a tighter monetary policy will be needed to contain price pressures. This is what happened in the late 1990s. There's also the flip side of it. Markets could reprice sharply. This would reduce wealth, consumption, and investment, lower activity, and could spill over to broader financial conditions.
Also flagged sort of high levels of uncertainty around trade policy. I was just wondering how much of an economic impact do you think there could be from the most recent tariff threats between the United States and China?
This is more of a downside risk in a sense. This is what we have to think about what could happen if negative trade measures were implemented, if some restrictions on exports of critical materials were implemented.
The IMF has repeatedly warned about trade uncertainty and its impact on the fragmentation of the global economy. I wonder whether you could share some thoughts on the fragmentation part.
We're seeing elevated trade tensions. We're seeing a number of industrial policy measures that are designed to protect or promote certain industries in certain countries. And we're seeing a reorientation of trade flows already. When we look at the global picture, it's not that trade has decreased. Trade to global activity, trade to GDP, that ratio has been more or less constant. We're seeing a lot less trade, for instance, between the US and China, but we're seeing a lot more trade between either US and China and other parts of the world. Trade matrix is changing. It's adapting to these tensions. And so far, it's not really declining, but it's become more complicated. It's a very much more complex picture.
In parallel, the Global Financial Stability Report underscores growing risks in financial markets. Despite calm markets in recent months, vulnerabilities are building beneath the surface. It was highlighted that there is an urgent need for governments to reduce deficits and ensure debt sustainability to ease pressure on bond markets.
In April, markets sold off in response to the tariff announcements, including stocks, longer-term bonds, and the US dollar exchange rate. Since then, markets have recovered strongly, with major advanced economies up about 10 to 15% year to date, and emerging markets about twice as much. Gold has rallied very strongly in response to high policy uncertainty, and so at this juncture, financial conditions are fairly easy across markets and across countries. Now, having said that, we see three vulnerabilities that we really highlight in the GFSR. The first one is that asset prices are stretched, so they are vulnerable to a readjustment in valuations. The second vulnerability is about the interaction with non-bank financial institutions. So if asset prices were to adjust, that could impact non-banks and could potentially lead to redemptions and further pressures on valuations. And then thirdly, longer-term bond yields have risen in a number of countries in recent years, and some of that reflective fiscal concerns around the world in many countries. Our punchline in the Global Financial Stability Report this time is that while financial conditions are easy, the macro-financial risks remain somewhat elevated.
I'm Indivari from Sri Lanka at the Derana news channel. I have a question on frontier markets like Sri Lanka, how the IMF is assessing investor confidence in countries like Sri Lanka that are emerging from debt restructuring but still face high borrowing costs and limited market access. What do you perceive as the key financial stability risks in this phase to recovery, and also in terms of stability risks as these countries implement structural reforms?
As you point out, Sri Lanka has been emerging from a debt restructuring and is on the path to growth and restoring confidence. When we look at global markets relative to frontier economies, so those are low-income countries with market access, we do see that financial conditions are fairly easy, so there is liquidity. Countries can access markets, and indeed, we have seen quite a bit of issuance this year that is in line with historical standards.
Sri Lanka's economic performance has improved, so it's good to see. On your questions on frontier in general, the softer dollar has lessened external pressure, but now is not the time to be complacent at the same time. So frontier economies need to continue to improve economic fundamentals. That includes both on the current account as well as fiscal buffers rebuilding, as our wheel colleagues have mentioned in the previous session. Importantly, in the GFSR, we also have the chapter this time about strengthening bond market structure so that frontier economies can obtain financing through domestic means rather than over-relying on external funding. And these include improving institutions' quality, improve the predictability of issuance, and further develop debt markets in ways that will be conducive to channel domestic savings towards governmental use. So overall, I think we acknowledge the resilience, that frontier economies and emerging markets have demonstrated through this period. Obviously, there's more work to be done as well.
The second chapter in the report focuses on the FX market, the structure, how it can affect other markets, and I could summarize it by saying FX matters a great deal. And I think we have a flavor of this earlier this year with the move we have seen with the dollar weakness.
This is connected to the gold reserves. Almost every country is going and parking a lot of their assets in gold. It's an attempt to de-dollarize, but will this build another level of risk? More and more countries park their money in gold.
When we look at official reserve holdings, there has indeed been a trend over several years already to increase gold holdings alongside some other commodities as well. And, to some degree that may have contributed to the valuation of gold, but this trend in allocating more reserves to gold has been, pretty steady over the years. So it's hard to argue that that would be a major cause for the run-up in the price of gold.
Well, today was a reminder, while global growth remains resilient, there are significant risks for countries, whether it's emerging economies or frontier markets like Sri Lanka. And the IMF continues to stress the importance of forward-looking policies to mitigate risks and bolster economic stability.